Yeah, so yeah, it's Brian Lewis checking back in, and it looks like our little red flags have turned into big red flags here. So this is actually going to be pretty interesting. It also roughly summarizes my entire experience here in Colombia so far. I've had a 12-year-old girl that was selling lollipops try to sell me cocaine, like on the seawall. I had, well, I had my life threatened twice, uh, like four times, almost in a street fight. Um, the most ridiculous one, walking on the beach. I had the cops. I've actually been stopped by the cops, like shit, almost 10 times and like illegally searched since I've been here. But the last time that I was stopped, they pulled a gun on me. Um, and the most ridiculous stuff happened in Cartagena. That town is just it's ridiculous. But in any case, this is Brian Lewis, MMT Investing, your spiritual advisor to random charts or whatever here. Uh, the like button, smash it if you like it. Yeah. So what's going on here is this is the Eurodollar futures chart. I use this chart to predict the interest rate cycles because it is totally just says where they are. So this is the dollar flows across the whole world, and what we're getting now, I didn't actually expect this. Like I had this consolidation here and we started breaking out. I'm like, oh, we're gonna probably pull down out of here, but what we've done is we've actually gone back to trend. So this is not a small consolidation. This is just a bigger consolidation, which could kind of run out possibly towards the end of this month. um, and like just previously, like this was already the biggest kind of flag consolidation on the entire history of the interest rate chart that I've ever seen. Like there's a kind of a small one like during the financial crisis. This is a huge, ridiculous bear flag on the interest rate cycle. But as of now, we're up high enough. Like we're up high enough where the the Fed, if it's still up here on the next Fed meeting, like they have room to raise it like 0.5 or something if they want to. They probably wouldn't do that. They're talking about pausing or whatever, but in any case, the Fed just follows this chart, and I'll just take a quick look at what this chart says basically. So you get your interest rate cycles, and so at the bottom of the cycle when you're going sideways, that's bull market territory. On the way up is kind of neutral, but this time it was so steep that we pulled down. At the top, it gets volatile. It's usually kind of bullish while it's going sideways, but at the top of the cycle, it's volatile and like kind of crazy. And then on the down moves, that's where you crash. These down moves are where you crash. That's like 2018 crash. This is COVID crash. If you go back to the previous cycle, and we had the huge bull market flat bottom for a long time after the financial crisis, but like these two down moves are the big two moves in the financial crisis on the way down. But anyway, that's just like the interest rate cycle, and you can get way ahead of it looking at the Eurodollar futures chart because it tells you the actual money flows like across the world. And the Fed comes out talking about stuff, but it's just a bunch of nonsense. Like they just follow this chart around and pretty much tell you where it is. But as of right now, the Fed's about this high. If they wanted to hike again, like 0.25, 0.5, they could hike. They could hike a couple more times. But I would expect when this pattern breaks down, it's going to drop. And when it drops, if it goes vertical, like that will be a down move in the stock market. That's the general idea here. I think Bitcoin has been leading a lot of the moves. Let me look at it real quick. Okay, yeah. So Bitcoin is just following a downtrend right now. It hasn't made a huge down move yet, but this is a big deal. It's consolidating and backtesting underneath this long-term trend line. This is like a 10-year trend line, and now it's underneath it. So I mean, just in general, like we're just near this trend line. Like for Bitcoin, it's not immediately crazy bearish. Like if we get on top of this stuff, that's gonna look really bullish. If it fails here, like it could take a big dive. It's a critical area for Bitcoin, and Bitcoin has been recently, like this year, it's been ahead of the stock market moves. So this is a good thing to look at. But let's go up and just take a look at the S&P. So the S&P has been on roughly a bull trend here. I mean, if you just like look at like the last entire year, it's just roughly been flopping around here. Up, blah, 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 whatever. It's just pretty much chopping around sideways for like a whole year. And that's all it's doing now. Nothing super interesting. Like kind of testing these resistance areas. It's like, meh, not going to crash, like just hanging out. So that's just kind of neutral. Technicals there. And yeah, the interest rate cycle looks dangerous, but it hasn't made a down move yet. Still consolidating. The treasuries are still consolidating. So that's what we're doing pretty much across all the charts right now. It's just consolidating and haven't really made a big move. Like the high yield chart, this is really interesting. Like this is big time resistance on high yield. High yield will generally crash before the stock market. These are the corporate bonds. And if you see the interest rate cycle move down, if you see high yields drop, those two lead before the stock market goes down. So this is a super interesting one to watch. But this is not breaking out. This is consolidating underneath the downtrend. And careful. So it just looks dangerous, but like hasn't happened yet. That's pretty much the story that I'm getting across pretty much all these charts. Yeah, corporate bonds versus like treasury bonds, man, whatever. DXY, this one's important. The DXY has been on this downtrend, which is bullish on the downtrend. And we left the downtrend now, and now we're back on this uptrend. And so that's going to be not immediately bearish. If it just weakly follows the uptrend, that's just pretty neutral. But if the DXY is ripping across channels to the upside, that's going to look bearish. But the down move on the dollar, it looks like it's busted. It looks like we're done with the down move on the dollar. So that's going to be neutral to bearish. Just looking at the dollar. If we look at the VIX, this is the volatility in the stock market, which was doing a flag similar to a lot of the other charts here. And it did a totally neutral, just kind of sideways breakout. Nothing's going on. So there's not really much to point out on the VIX other than it is pressing on this long-term trend line. Like it pushes and it'll pop off of this trend line, comes down, pops off of it, pops off. So when the VIX pops to the upside, that correlates with a down move in the market, but the VIX doesn't move before the market. It moves with it or after it. It's not really a leading indicator, but it's in a dangerous kind of spot. It just hasn't happened yet. Move index, I actually didn't realize they had the move index on TradingView until like 2 weeks ago, which is awesome. The move index is the volatility in the bond market, not the stock market. And so I drew out this pattern of what the move index does when you have peaks and down moves in the market. And so the lower the volatility is here, the safer the market is. As you go up and up and up, it's more dangerous market. So we're up in dangerous territory here. But you can see here on the chart, what it does is you put in a higher low. You put in a higher low on the move index, and then that higher low marks a peak in the stock market, boom, and then you have a down move in the stock market. Same kind of thing. You put in a higher low, boom, down move. So I've been watching this, and that might be the low. Like if the move rips up to a higher low here, that's going to be the peak in the market right now, like the past week. We'll see what it does. But you can kind of just see the pattern here on the move index, which is really great. The move index is a killer index, and this is also pretty much leads. This is a leading indicator. So between like the Eurodollar futures, the move index, and just looking at like high yield corporate bonds, like those are killer good. Treasuries are semi-useful as a leading indicator, but those are the leading indicators are saying like it's dangerous, but it hasn't happened yet, basically. No specific timeline. If you look at the yield curve inversion, this is the 10-year U.S. Treasury bonds minus the 2-year, right? So when it's below the yellow line that I painted here, that means it's upside down. That means that the 2-year treasury bonds are yielding more than the 10 years, which should not happen. That only happens when the market like rips up like higher than it should be, which is where we're at now. Which if you go back to the Eurodollar futures, you can see like we just ripped up to a level that is unsustainable. The banks are all upside down on their treasury bond holdings. That's why the banks have been failing, because they're upside down on their treasuries, right? And this shows you why. Look, they're upside down. Anyone holding long-term bonds is just straight upside down on them. That's why the banks are in trouble. That's why they had to open the lending facilities. People are calling it a bailout. It's really not a bailout. The Fed just offers loans to the banks that cannot, like if they sell their treasuries, they're screwed because they have to sell them at a loss, right? And so the Fed's like, hey, don't do that because you'll collapse. Take a loan, but the loan is not a good interest rate. Like they're getting a bad deal on that loan, and they can't hold it for like a year, 2 years. Like they'll still collapse anyway. So like the banks that have taken those loans out in order to not sell their treasuries, they're not winning right now because it's staying up. Like it's staying up. They're still upside down. They're holding these loans. They're still upside down. But it prevented people withdrawing like tons of money. That didn't really prevent it because people have been doing it anyway. So what we've seen the past 2 months is tons of people taking money out of small banks, putting it into big banks like JP Morgan Chase is the only bank. There's only one bank in the entire country that has a positive balance sheet, and JP Morgan Chase is the only bank that has a good balance sheet right now. But all of the big banks that are tied to the Fed, Wells Fargo, Bank of America, Citibank, like people are moving to all the big banks just because they feel like that's safer. And there's thousands of small banks that are in big trouble. Mostly just because they're upside down on the treasuries, just because of the interest rate cycle. But also right now what we have is real estate, particularly commercial real estate. The banks on their balance sheets will hold treasuries. They'll hold federal, they'll hold bank reserves, like Fed bank reserves, but they also hold a ton of mortgage-backed securities. So like on their back half of their balance sheet, that's what they're holding, and then they have their loans on the other half of the balance sheet. But the commercial mortgage-backed securities are in big trouble right now because just physical commercial buildings they're in trouble for every reason. Like online sales are dominating, local sales, the real estate's coming down in general, like sales, and the economy is slowing down. Just like everything that could be bad for commercial real estate's happening at the same time. So all the banks are upside down on their treasuries already. They're taking these loans from the Fed. They have no way to pay those back. They still can't sell their treasuries. And now the other holdings that they have, like any of the mortgage-backed securities, but particularly the commercial ones are like in big trouble. So that's what's going on with the banks. But in any case, right now we're just kind of chopping sideways, and nothing looks that crazy. But yeah, here's the NASDAQ. So we had like a negative divergence here that looked dangerous, and the NASDAQ has popped out of the top of that. So we're just getting a mixed bag of signals basically across the charts. That's like, yeah, like we're gonna roll into a recession at some point. But if you go back to the yield curve, like it's down, right? And I painted this flag because it looked like we might be like breaking out to the upside and heading into the recession, but we broke to the downside, which means that we're just continuing the inversion. And so the deeper, we're not going to start the recession until we break back to the upside. So we're not going into recession like this week. We broke to the downside on the yield curve inversion, but the deeper, like this is the deepest yield curve inversion probably ever. I think that's the deepest one that ever. But so the depth kind of the depth of the yield curve inversion gives you an idea of like how big the recession will be, and the length of the yield curve inversion gives you an idea of like how long it will be, roughly. So right now, this is looking like it could be the biggest recession depression ever. Based on this is more than a year, and it's like the deepest inversion ever. Um, but just in terms of like timing, when we roll into it, yeah, it's kind of hard to tell. It looked like a good technical pattern, but it didn't happen. So we're just still kind of chopping sideways, like teetering on it. And for now, as long as we're stable on the interest rates, the stock market can be bullish. It's not necessarily bullish, like it's just kind of a volatile territory, but it can literally just go crazy like any direction. It's really hard to trade at the top of an interest rate cycle. It's very difficult to trade because it's just very volatile, and it's very hard to tell like what direction it's trying to go. But this week it's up, and I just try to figure out. Oh, and this is really cool. This is the NASDAQ versus the S&P. So what I was saying is we broke down and back tested this. So it looked to me like the NASDAQ was going to get in trouble versus the S&P like longer term. Like the NASDAQ may underperform for a while, but bam, we're like back on top of the NASDAQ uptrend now. So that's really cool. That's a bullish sign in general for like tech being okay. Like tech is back on top now. So it's just a mixed bag of signals. Just trying to take a look at like what's going on. We are going to roll into a recession. Yeah, I don't know. A month, a year, I don't know. Like I was saying a couple weeks ago, I was saying like 6 months is probably the longest window I could see. Now I wouldn't be surprised if it's a whole year from now when we start going into it. I have seen the charts that where the not the unemployment rate. The unemployment rate is staying down, but the job openings are really dropping. And so that usually leads the unemployment rate going up. I mean, we have the all the signals that a recession is coming, like all of them, every single one. But when it comes, is not very clear, not clear signals. But in any case, taking a look at some other stuff like silver, the precious metals are just on a general uptrend, and they're just kind of chopping around and holding the uptrend. Silver looks okay. Oil's on a downtrend, which is an indicator that we're headed into recession, and it hasn't like collapsed yet. Like when we go into recession, like oil probably will drop off pretty hard. Gold's holding an uptrend, and the uptrend on gold is a long time. It's like whatever, like 12 years or something, and it's just right at trend. No big deal. Um, Copper is like a little weak. Oil's a little weak. So those are indicators that we're headed towards recession, but it's not like an imminent kind of signal. Right, and yeah, Bitcoin's in an interesting technical position, and it's super volatile, but it hasn't broken down yet. And you can see this chart. This is the Bitcoin ETF, just to clean the chart up a little bit. But just looking at Bitcoin, you can see like flag to trend, big bear flag, right? Back to trend, bim to trend, flag to trend, bear flag to trend. Like it's just like whatever, like 8 bear flags. This is a bigger one. This looks like a giant bear flag, but if this is a big bear flag that breaks down back to trend, like that is going to be a monster down move on Bitcoin that will freak everyone out, that takes out the lows by a huge amount. That is exactly what I expect to happen. And when, I don't know. Soon probably. Just looking at the technicals, like if this breaks down out of here, that's going to start looking really scary. Just going back to the main chart, it's the same thing here. Like we've broken, this is the huge long-term uptrend. We're underneath it, backtesting it. Like if we fail here, it's going to start looking really scary on Bitcoin. And that could lead, lead a down move in everything. Like Bitcoin has been moving early. BSV, blah, 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 blah. Coinbase, whatever. That's just one stock. Nvidia is an interesting one. Yeah, this is wild. So yeah, the NASDAQ now has gone strong again. I didn't expect this to happen. The Nasdaq has gone strong versus the S&P again, and Nvidia is the leading stock in the Nas for right now. It's like the AI, semiconductor, Nasdaq, whatever. Like all of the meme kind of it's like the meme stock for this year, except that it's like a not ridiculous. It's actually a good company. But this is one of my favorite stocks to kind of look at the growth sector. Like this is the leading stock in the growth sector, I think, right now. And so, boom, we got a big pop to the upside. So that'll be really interesting to see if this reverses or if we get like a bull flag out of this. This is a good stock that can kind of indicate the timeline on what we're doing relative to a recession. You know, Tesla, kind of the meme stock for the last several years, has just kind of, I mean, you can just see here, it's been just kind of flopping around sideways for like 2 years. It's just right on the sideways trend, like nothing very interesting. If you look at the structure of the chart, you know, you have kind of this bubble pattern on this uptrend, and it's testing it now. So if Tesla breaks down, it'll, you know, it'll take out the lows like here. If it holds trend, bullish, like whatever. That's just kind of in an interesting area there. The banking sector. So yeah, banks obviously crapped out like a month ago, and it did a consolidation. So this is the whole ETF for the regional banks, the KRE, and so what are we doing? Like I think we're actually still we're in like a I think we're in some sort of like a channel like this. Actually, I think it's just in a consolidation channel and hasn't really decided where it's trying to go from here. I think most of the banks have like held up. Yeah, so this is kind of the pattern. Like we had this kind of bear flag looking pattern, which I was like, oh, that's looks super dangerous on the technicals. But most of these bear flags have resolved just sideways, and that's what you get across most of the banking charts. Some of them are a bit down, some of them are neutral. First Republic was one that actually crapped out. Like they actually their ticker symbol disappeared. It disappeared and then it came back. I don't know what happened there because J.P. Morgan like bought them out, I think, and somehow their same ticker symbol came back. I don't know the story on that, why their ticker is back, but yeah. Anyway, this is one of the ones that collapsed, and I have a list of other ones, all these ones here, that could collapse. It's like Citi, like Comerica, U.S. Bank Corp. These are the ones that have the worst balance sheets or like the most people over like the FDIC limits, just whatever kind of banks that have some risk. Truist is risky, Zion's risky, but most of them have roughly just kind of Pac West is dangerous, Western Alliance. Like if we have another series of bank failures, like I would expect pretty much all of these to get in big trouble. And then we have like a pile of meme stocks down here from the last couple of years that are not super interesting now. I think that's probably about it. I just wanted to run through. I don't even know what to call this video. I got to come up with some kind of snappy name or something. But yeah, in any case, we're still just kind of chopping around. We're still kind of chopping around sideways. We're still trending towards a recession, but the technicals did not break down yet. The interest rates did not break down yet, and so we're not going into a recession yet. But we will, for sure. It's just a matter of how deep and steep it is. So when the interest rate cycle rolls over, you know, if we kind of go down and sideways, it'll just be kind of a gradual, kind of weak recession. It could last for a long time. But if we dive down, boom, and dive down, like those will be big crashes. And just kind of what the interest rate cycle looks like and how it affects the stock market. like we're getting near the down cycle, and so we want to see what it looks like, what it's gonna be. So good luck, happy trading, and yeah, have a good week.